Welcome to our channel. Please like and subscribe. What if I told you there's a way to make money, not by owning a company, but by lending money to one, and instead of hoping the price goes up, you get paid regularly, predictably. This is how bonds work. But most people don't understand them. They hear the word bond, and it sounds complicated, slow, or not worth learning. But once you understand how bonds actually make you money, you'll see why investors use them to build stability, income, and long-term wealth. Let's begin. First, what is a bond at its core? A bond is a loan. When you buy a bond, you are lending money, not to a friend, but to a government or a company. And in return, they agree to pay you back with interest. That's it. Now let's make this simple. Imagine you lend someone $1,000. They promise to pay you back in 1 year, plus 5% interest. At the end of the year, you get your $1,000 back, plus $50. That's exactly how a bond works. Now let's go one step deeper. There are 3 key parts of a bond: the principal, the interest, and the time. The principal is the amount you lend, the interest is what you earn, and the time is how long the loan lasts. Simple. Now let's talk about how you actually make money. There are 2 main ways. First, interest payments. Most bonds pay you regularly, monthly, quarterly, or yearly. This is called income, and it's predictable, unlike stocks, which can go up and down. Bonds are designed to pay you consistently. Second, price changes. Bonds can also be bought and sold, and their price can change. So you might buy a bond and sell it later for more than you paid. Now here's where things get interesting. Bond prices move based on interest rates. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. Why? Because new bonds may offer better returns, making older ones less attractive. This is one of the key ideas to understand. Now let's talk about types of bonds. There are 2 main ones you'll hear about: government bonds and corporate bonds. Government bonds are issued by countries. They are generally considered safer because governments are less likely to default. Corporate bonds are issued by companies. They usually offer higher returns but come with more risk. Now here's something important. Bonds are often used for stability. Investors don't just want growth, they want balance. Stocks can grow quickly, but they can also drop. Bonds provide steady income and reduce overall risk. That's why many people combine both. Now let's talk about risk. Bonds are not risk-free. The main risks are the borrower not paying back, interest rates changing, and inflation reducing value. But compared to many investments, bonds are considered more stable. Now let's simplify everything. A bond is a loan. You lend money and earn interest over time. You can make money through regular payments and sometimes through price changes, and they are often used to create steady income and reduce risk. Now here's the mindset shift. Most people focus only on growth. How can I make more money quickly? But experienced investors think differently. They ask, how can I make money consistently? Because consistency builds stability, and stability builds long-term wealth. Now imagine this. You own multiple bonds, each one paying you regularly, month after month, year after year. Even if the market changes, you still receive income. That's the power of bonds. Now take a moment. You don't need to understand everything at once. Just remember this. Stocks help you grow money. Bonds help you protect it and generate income. And when you combine both, you build something stronger. Because wealth is not just about growth, it's about balance. And once you understand that, you start thinking like an investor, not just someone chasing returns. That was excellent. Please like and subscribe for daily lessons. See you next time.